In a world of already low global interest rates, South Korea and New Zealand's rates just got lower. South Korea cut its interest rates to a record low of 1.5% as it tries to contain the economic fallout from a deadly outbreak of the Middle East respiratory syndrome. New Zealand cut rates for the first time in 4 years to 3.25%, with falling dairy prices a key factor in the decision. In the US and UK, interest rates have hovered near zero for almost a decade. Super easy credit and quantitative easing policies were put in place to help nurse economies back to health following the financial crisis. But are low interest rates still proving useful? James Bevan from CCLA.
It is certainly the case that many central banks now appear to be pushing on a piece of string and are not getting the sort of traction from monetary policy that they had previously anticipated or expected.
Some are now asking whether ultra-low interest rate policies are actually doing more damage than good. Global bond markets, among other assets, have been hit by volatility. That's something ECB President Mario Draghi says markets should get used to in a low interest rate environment. And there are fears asset prices are becoming detached from the real economy.
The biggest bubble must be the housing market in China, followed quickly by the equity market in China. Both are on extraordinary valuations, driven significantly by fund flows rather than strong fundamentals.
And when rates do start to normalise, there could be more volatility ahead. IMF chief Christine Lagarde.
Regardless of the timing, higher US policy rates could still result in significant market volatility with financial stability consequences that go well beyond the US borders.
Analysts say the timing and manner of the normalisation will be key.
If monetary tightening in due course is slow and gradual and measured relative to the progress economies, markets need have nothing to fear. If, however, central banks tighten aggressively and inappropriately, markets will most certainly collapse.
An outcome the world's top central bankers will be working hard to avoid.